everybody. Reporting to you again from the Glamour City, Hollywood.
We can't deploy it fast enough. There's a bottleneck in deploying it. So it doesn't matter how efficient solar panels are, how efficient the new EV is, or whatever technology you're talking about. If you can't get it deployed, it doesn't matter. It's not relevant. So I wanted to solve that problem, the deployment problem. I wanted to basically eliminate the sales cycle of deploying clean technology. And it dawned on me that if I own the real estate, if I am the owner, I can deploy clean technology as fast as I want.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today, I'm joined by Owen Barrett, co-founder and president of Rayven. Welcome to the show today.
Thanks for having me, Scott.
Owen, so you have a finance degree, but you also have a master's degree in environmental science and management. I want to ask you, back then, what made you want to focus in that area?
I've spent a lot of time outside. I used to be a rock climbing instructor at Yosemite. And, even 15 years ago, I was starting to see the effects of climate change. And I did not want my career to be sort of separate from my passion. So I recognized that there was a way to bring the two together if I could figure out how to get into corporate sustainability, which at the time was sort of the field was really just starting.
Yeah, remind us about what time period that was.
So that was about 2008. And really, if you wanted to get involved in corporate sustainability, the only route at the time was getting involved with LEED, which I didn't really want to do. I wanted to be more sort of on the decision-making side within corporations, not on the outside consulting people how to build the right way through LEED.
Well, clearly you're easily 10 plus years ahead of everyone else. And of course, that field has become a very burgeoning and a very ripe field as of now.
Yeah. I mean, it's awesome to see, right? I think we need more people joining it. I still think it's very new. I mean, I think we're at the very beginning of a huge transition. So I think there has to be a lot more people involved if we're going to make the changes that we need to. Sure.
Now, you've eventually worked on implementing clean technologies across things like fuel cells, solar PV, energy storage, and HVAC. I wonder if you could tell us a little bit about that.
Yeah, so my first real job after graduate school, I had a couple of fellowships, but then I got hired as an energy manager for a Fortune 100 life sciences company in Southern California. And essentially, I could convince our C-suite to implement any clean technology project or any project really, as long as it met certain financial metrics. At the time, it was a 4-year discounted payback. And so my job was to research technologies that would save energy and save money that I could get to fit that 4-year discounted payback. So over about 3 years, got to implement a couple of fuel cells, which generate electricity from natural gas. So they're a lot more efficient, a lot cleaner than the grid. They also provide emergency backup, which is a cool kind of side functionality. A lot of LED lights, solar, energy storage, and then some HVAC optimization projects. So it was a really interesting time because I had a lot of freedom to talk to different vendors, talk to different companies, to try and explore what was out there, what was cost effective at the time. And then that sort of knowledge concentration allowed me to then start my first company, which ultimately just deployed all those skill sets, but on my own, not with a company. So it was a pretty cool transition.
So I think what's interesting, again, trying to understand kind of the time period, because it has to be in the context of incentives and legislation at that time. So can you give us an idea of what the legislative environment was and what kind of incentives were around those types of carbon neutral or clean energy solutions?
Yeah, so at the time, and this was in California in 2012, kind of 2012 to 2015, there were no incentives for solar. There was the tax credit, and it was 30%, which was helpful. For fuel cells, there was a program called the SGIP, Self-Generation Incentive Program, which I think is still around. Really, the point of any rebate or incentive is to help a technology get to sort of commercial scale. So even at 2012, commercial solar was already there. I mean, it was already cost effective. So the state didn't feel like it needed to incentivize it more. Fuel cells were just taking off. There was a lot of rebates through the 3 investor-owned utilities for LED retrofits, which was really cool. That was just, that was a huge boom that happened really quickly. And then HVAC, it kind of depended on what kind of projects we were talking about, but there were some incentives through utilities for HVAC projects as well. So I would say just it depended. The tax credits were always there. The rebates really depended on the technology and sort of where they were along their own specific adoption curve.
Yeah, so I think to understand is that by then there was already that competitiveness from a levelized pricing of solar relative to, let's say, oil and gas-based types of energy sources. So it was already fairly prevalent. But I want to talk about in the context of Lumio, which is I think what you're alluding to. You have to sign up school districts, right? And I wonder, when you're dealing with school districts and the school boards and the committees, what were some of their concerns and issues, and how did you overcome that? Because it wasn't just purely economics, was it?
No, it wasn't. That's a great question. The problem with school districts is that they get in their own way. Oftentimes you have superintendents, so essentially CEOs, right? The school districts, and some of these school districts in California and other states are $100 million budgets. They're massive organizations, and you have someone in charge that has come up through the ranks of being a teacher, which makes absolutely no sense to me. So a lot of the challenge that I had with Lumio was trying to convince people that really had no business acumen how they should be evaluating clean technology projects. The board would have to get on board. So that was a tricky situation. And a lot of times school districts wouldn't even want to move forward with a project because they had to go through the RFP process. And this is really interesting. RFP process within a public school district takes a lot of time, a lot of resources, obviously. So some school districts just would say, we don't want to do the project because we don't want to go through that RFP process. In California, there's a piece of legislation that says if you're a public agency and you enter into a performance-based contract, so a contract where the customer doesn't pay for anything out of pocket and the monthly or annual payments are covered by the energy savings, those public agencies can sole source the project. So they actually do not need to go through the RFP process. So what was most interesting is when I would hear the sort of the roadblock, we don't want to go through an RFP, then I would bring up this piece of legislation and say, actually, you don't need to go through the RFP process. You can just sole source it. We can help you select the vendors. And then the excuse was, well, we're not really comfortable if we don't go through the RFP process, because what if we pick the wrong vendor? Then, who's going to get blamed ultimately was a concern. So there was just an unbelievable amount of excuses and reasons not to do projects. Fortunately, there's a lot of school districts that could make the right decision and move forward with a lot of projects, because there was a lot of money floating around for school districts to pursue renewable energy and energy efficiency at the time. So a lot of school districts moved forward, but there were quite a few that just couldn't get out of their own way.
And I do think that a lot of these challenges are kind of inherent to your point. I mean, outside of school environments, RFP, RFIs, requests for proposals are fairly common. I mean, just the way things are done from a procurement process. But the fact that they didn't want to go down that route, again, is a good reflection of the fact that that's not the business nature that they're working in. But yet, my understanding is that you were able to scale that business quite a bit. So how, despite the bureaucratic challenges, how did you manage to sign up so many school districts?
I hired an insider. Is really what it came down to. I figured out very quickly that schools were not really interested in talking. They didn't want to form new relationships, but they were really comfortable pursuing business with existing relationships. So I found someone that had a lot of experience working with small rural school districts, because that's kind of what we targeted. We noticed that so there was a program going on at the time called Prop 39, and it was essentially free money for school districts if they invested in energy efficiency and renewable energy, so long as the savings to investment ratio is greater than 1.01, which is a pretty easy benchmark to hit. And what I noticed really quickly was that the larger school districts were getting all the attention of the big ESCOs, the big energy service companies out there. But the smaller, more rural school districts were being left behind. And those districts had a ton of money. I mean, they had $5, $10, $15 million, but it wasn't enough to capture the attention of these big ESCOs. So I found someone who was really well connected to small rural school districts all throughout the state. And that really instantly increased the velocity of our ability to execute projects. So, part luck, part skill, but it was that ability to sort of identify early on that if we could somehow foster a relationship faster, then school districts were more willing to entertain these projects and ultimately move forward with them.
Yeah, that's a great example. And in some ways, actually, that type of a strategy isn't really talked about as often. We see it in defense, for example, defense space where, let's say retired colonels, generals, and other high officials, for example, will become part of the management team, whether they're operational or not, but they bring the credibility and the background, the relationships. It's interesting, and I think that's a very important piece that oftentimes I think people do kind of forget. Of course, if you're in charge of sales, I think people do understand that quite a bit. Let's move on to ZNE Capital. What is it, and how are you looking to help accelerate sustainability in the context of real estate?
Yeah, so Lumia was great. I ultimately, after 2 or 3 years at it, I just got burnt out trying to convince school districts to move forward with these projects. So I exited that company and had some time to reflect. I knew I wanted to stay within sustainability and clean technology, but I didn't know exactly what I wanted to do. I knew I couldn't go back to the corporate world because I had a taste of entrepreneurial success. So I had sort of the fortune of just being able to really brainstorm for like a year, researched a lot of different areas, read a ton of books, listened to a ton of podcasts. And over that time period, I sort of reflected on my time in the clean tech industry and really got comfortable with this idea that we have the technology that we need to solve climate change. The problem is, we can't deploy it fast enough. There's a bottleneck in deploying it. So it doesn't matter how efficient solar panels are, how efficient the new EV is, or whatever technology you're talking about. If you can't get it deployed, it doesn't matter. It's not relevant. So I wanted to solve that problem, the deployment problem. I wanted to basically eliminate the sales cycle of deploying clean technology. And it dawned on me that if I own the real estate, if I am the owner, I can deploy clean technology as fast as I want. And so I went down this path of understanding real estate, learning about it. Again, a lot of books, a lot of podcasts, a lot of interviews. And after probably 2 to 3 years of research and making sure we're approaching the right market, approaching the right kind of property, bought a 64 unit in Tulsa, Oklahoma, and decarbonized it instantly. I mean, within 6 months, it was decarbonized. And then we moved on to a 232 unit in Fort Worth, Texas, a 235 unit in Dallas, Texas, a couple properties in South Dakota. And so it took a long time to get started, but it grew really quickly from there. And all of our properties are decarbonized or partially decarbonized within 3 to 6 months of ownership. There's no friction within that decision-making process because we're buying it to decarbonize it. So there's nobody to convince, which is, it's a breath of fresh air. It's so much easier being the owner.
So let me just make sure I understand this a little bit. Is again, this is prior to the Inflation Reduction Acts, right?
Mm-hmm.
And what type of incentives, again, going back to what I said before, kind of policy environment was there at that time for property owners and property developers?
There was none, and there don't need to be. Solar stands up on its own. You don't need any incentives. The problem really is that it's a timing problem, and it's how the solar industry is pitching solar to the commercial real estate industry. So on the timing problem, real estate owners are putting together a capital stack. So they say, the property costs $10 million, and then I have $3 million of renovation. So $13 million capital stack. You're going to borrow probably 60 to 80% of that as debt. You're going to raise the rest as equity. Once you acquire the property, your business model is set in motion. You can't suddenly say, oh, I also want to install $1 million of solar, because you don't have the money for it. And the options for commercial solar financing are terrible. So what I understood was, if you go into that acquisition process and build the cost of capital into your capital stack, you borrow most of it through your senior lender, but you raise a little bit of additional equity, then you can implement solar because you have the funds already once you close. So that was a timing piece. The way that it's being pitched to the industry is within the residential space, solar is usually pitched on a simple payback. So, depending on where you live, it's probably 3 to 10 years. As a homeowner, you think, okay, I'm going to be in my house for 5 years. So if I install solar and the simple payback's 3, that makes sense. For multifamily owners, that makes no sense, because the velocity at which multifamilies properties buy and sell is 3 to 4 years. And it's really hard to get a 3 or 4 year payback for multifamily. So people are pitching payback, and it doesn't make any sense to the owners. So it's not getting adopted. But if you look at it differently and you apply what's called a cap rate to the annual energy savings, which is how you determine how much value is created from that project, solar instantly adds more value to commercial real estate properties than it costs. But nobody in the solar industry knows to pitch these projects that way. So it really took sort of this combination of understanding clean technology, understanding commercial real estate, and putting the two together to develop the best way to incorporate clean technology into commercial real estate projects.
So let's talk about more current time. So again, we're in the context of Inflation Reduction Act, which is a very powerful legislation, probably in history, for this kind of sector that we're talking about. What does it mean for commercial real estate property owners, developers, and managers? And does it in fact change the model?
Yeah, oh, absolutely. It means it's the best time ever to electrify and the best time ever to install solar. I'm not super familiar with commercial real estate outside of multifamily, but for multifamily, there's a couple things that are going on. A big one is that the tax credit is now transferable. So you can sell it to outside parties unrelated to the solar project itself. That's huge, because real estate projects generate so much depreciation that tax credits are virtually worthless. So the tax credit never really helped multifamily owners with their solar projects. The other big piece is that it was bumped back up to 30%. So it was at 26%, now it's 30%. If you're in certain energy communities, it's 40%. If you're low to moderate income, it can be 50%. So now you're talking about half the cost of solar in a tax credit, which you can sell. Once that market matures, the discount rate on the tax credit is probably going to be 5 to 10%. So if you have $1 million tax credit, you can probably get, $900,000 to $950,000 cash for that tax credit, which is unbelievable. The other big thing is, I think there's about $20,000 per unit in rebates for electrification. So obviously the direction that the grid is going and putting in on-site solar, you want your property to be as electrified as possible. That's really costly. And so now with the Inflation Reduction Act, it makes all the sense in the world for multifamily owners to integrate electrification with their value add process and then install solar because it's suddenly way more cost effective.
So, given exactly what you just shared, in that context, does it make sense to still buy the properties and then install the solar panels?
Yeah, absolutely. I mean, we've had the solar investment tax credit, I think, has been around for 20 or 30 years. The solar adoption on residential real estate in the US, I think, is 3%, and multifamily, it's less than 1%. So, it's great to have tax credits and rebates, but there's still going to be a bottleneck at the decision-making process level. So even though it's capital intensive, the most efficient way to decarbonize for us, because we have skill sets in both, is to own the real estate.
All right, so let's talk about Rayven. What is it, and how are you guys changing the model in real estate and allowing access for retail investors?
Yeah, Rayven is super exciting. What I recognized with ZNE is that there's a lot of people out there, a lot of institutional groups, a lot of family offices, a lot of private equity that kind of tout themselves as environmental impact investors. And we've talked to all of them, and they're not authentic in what they're putting out through their marketing. So all of these groups say they want to achieve, huge environmental impact. None of them are willing to sacrifice financial return for environmental impact, which, I would call them out and say that's not impact investing. That's just regular investing. So I'm optimistic that impact investors exist, but I think it's at the individual level more so than the institutional one. And so what's really exciting about Rayven is it's the same business model of buying apartment buildings and decarbonizing them. So we're owning the apartment buildings and we're implementing the clean technology. What's different is how we're raising equity. So rather than try and convince a family office to write a $10 million check, we've decreased the minimum investment to $250, and we're effectively trying to crowdsource $75 million from concerned citizens about climate change that think there's a lack of action against it. They do not have to be accredited investors, which is, a tough barrier to cross for most people. So we like to think that we're democratizing the opportunity to invest in net zero real estate.
So what exactly is the retail investor getting in return?
They're getting a 10% annual interest. So we're pooling investment together. Once we have enough investment, we go buy properties. They're usually 50 plus units. And then in terms of sort of how the returns are structured, the first entity we have to pay back is the senior lender. The second entity we have to pay back are Rayven investors. And then third are the principals of Rayven. So we've tried to put the Rayven investor in a preferred position just to really de-risk their investment as best we can.
So to be clear, the retail investors are not participating in the capital appreciation, and they're not receiving any of the cash income that's generated from these passive portfolios. Is that correct?
No, they are participating in the cash income. They're the first group in place to receive distributions from the property, but they're capped at a 10% annual interest. And the reason that we structured it that way is what we found historically is when you try and pitch the upside to impact investors, it doesn't matter. They will not sacrifice financial return for environmental impact. And so then pivoting to retail investors, a 10% return is pretty good for most retail investors. Most retail investors do not have the sophistication to get much beyond that. They don't understand the complexities of, investing into a syndication for the most part. So we wanted to make it very simple. You invest in net zero real estate, you earn 10%, you are helping decarbonize America one building at a time.
So putting aside the retail investor cap portion, what are some of these portfolio properties actually deriving in terms of cash flow? And 10% represents what percentage of the total generated income?
I mean, it's the bulk of it. So what we see on a net zero property, I would say pretty consistently is like a 10 to 14% IRR. That's over usually a 5 to 10 year hold period. Cash on cash, is anywhere from, I would say, 8 to 12%, and it changes during the stabilization period. So the bulk of the returns, just like a traditional real estate model, the bulk of the returns are going to the LPs, who in this case are the retail investors. And then the upside, assuming the business model goes well, goes to the principals of Rayven.
So let's talk about risk and what does the risk that the retail investors have to bear. So given the context of the rising interest rate and commercial properties and certain multi-units also are challenged with the higher cost of financing. And there are many large real estate groups and fund managers that are offloading their properties because just, the math just doesn't work out anymore. So what does that mean, and how do you protect the investors?
Yeah, I think you have to buy right. So there's always going to be people sitting on the sidelines because they say now's not the right time to buy. And those people generally are going to sit on the sidelines their entire life. There's never going to be a right time for them. Rising interest rates just means that you have to underwrite properties differently. I would say you do have to account for expanding cap rates as well, which is, not to be ignored. But we're still finding properties that cash flow 6, 7, 8% right out of the gate. We're using fixed debt. So we're using agency debt on acquisition. So agency debt being Freddie Mac or Fannie Mae. We're using fairly low leverage, 65, 70%. Our interest rates are fixed for 10 years. There's usually interest only for 5 years. So in my mind, if we are truly in an inflationary period, which I would agree with, and we're finding cash flowing properties from day one, and we're putting 10-year fixed debt on those properties, the longer that we're in this inflationary period, the higher the pressure on rent is going to be, which is going to grow the delta between our expenses and our income, which is a good thing for us. So I think the period of transition can be risky if you buy at the right time. But I think as long as you're underwriting conservatively, there's still a ton of deals to be had. And we're finding them all the time.
So I want to talk about some of the specific properties. I think there's one in Estrella in Texas, BG Flats, and Champion Villas in South Dakota. And the reason I'm bringing it up is, again, if the goal is to decarbonize faster, both from scale in terms of number of units, but also the effect of removing pollution from the air, wouldn't it make more sense to have properties in LA or New York?
Can I ask why?
Well, I don't know if the question is a why, but we're talking about areas that are not necessarily heavily polluted per se. So again, from an economics of purchasing those real estate properties, it makes sense, but from a carbon big picture perspective.
Got it. Yeah, I mean, at the end of the day, our model is it's a clean tech model on top of a real estate model. And going back to your question about risk, I would not feel comfortable buying a property in New York or California. There's too many risks on the real estate side. I've lived in California for 10 years. I've lived with 2 squatters. And in both instances, it took 4 to 6 months to get them out. Now, if you multiply that to 100, 200 unit property, that's a huge amount of risk that I'm not willing to take for myself personally. And I'm not willing to take for the people that are investing into our properties. Additionally, climate change from a carbon perspective is a global problem. So whether we're removing kilowatt hours from South Dakota, Texas, California, international, I would agree with you that the carbon intensity of kilowatt hours changes depending on the grid that you're located in. But ultimately, a kilowatt hour avoided is a good thing, regardless of where it's coming from.
I've been joined by Owen Barrett, president of Rayven. Thanks for joining today.
Thanks.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.